Welcome back to BlockNexus TV, where the noise gets muted and the signal gets amplified. Today's episode is all about a single brutal question. Is crypto dying, or is this exactly how the next bull monster is born? In the past few weeks, Nike quietly walked away from its hyped NFT studio. The NFT market has cratered. Bitcoin is stuck in a boring range with $80,000 lurking below. And at the same time, JPMorgan is pushing its own digital dollar onto a public-style blockchain. If that sounds contradictory, it's because crypto is standing in the middle of a massive reset moment. Stay to the end, because this isn't just a news recap. It's a roadmap for what survives, what dies, and where the next 100x plays are likely to come from. Nike dumps NFTs, end of the hype era? Nike just sold off RTFKT, its digital products and NFT unit, in December 2025, and the buyer hasn't even been publicly revealed. Remember, Nike bought RTFKT back in 2021 at peak metaverse mania. Then, in early 2025, announced it would shut down Web3 services and pause NFT drops while only keeping gaming wearables alive. This exit didn't happen in a vacuum. Nike's Converse brand reported roughly a 30% sales drop in Q4 2025. So the new CEO, Elliott Hill, has been refocusing the company on core sports and footwear instead of speculative digital bets. At the same time, the broader NFT market cap has collapsed by more than 67% over the past year. Monthly NFT sales fell sharply in late 2025, and big platforms and events are either pivoting or shutting down. OpenSea is shifting away from NFTs only toward a wider trading model. X2Y2 has closed its NFT operations and pivoted to AI. And Rarible had to overhaul its trader reward system because the old incentives were unsustainable. Even major events like NFT Paris and RWA Paris have been canceled for February 2026, explicitly citing the rough market conditions. The message is clear. The speculative, JPEG first phase of NFTs is over. Only NFTs with real utility or deep brand integration are likely to survive. Bitcoin, boring, right before the big move. While NFTs unwind, Bitcoin isn't crashing, but it also isn't mooning. Bitcoin has been trading in a defined range, repeatedly failing to break through resistance near around $95,500, with each attempt getting rejected. Those rejections show that sellers are still very active at higher levels, and that demand just isn't strong enough yet to absorb supply. Under the surface, the rally looks weak. Bullish volume is muted, conviction is low, and that usually means the move up is more corrective than impulsive. Technically, the key level everyone is watching is the lower boundary of the range, around $80,000, which has become the major swing low support. As long as price stays capped beneath resistance and doesn't explode higher with volume, the probabilities favor a rotation down toward that $80,000 area to rebalance the range. There is a point of control zone, an area with the highest recent trading volume, that has been temporarily propping up the price and preventing a fast flush. But that kind of sideways hold usually signals balance between buyers and sellers, not strength. And if that support gives way, a deeper move to test the range low becomes more likely. In other words, this is the calm part of the storm, not necessarily the end of the story. JPMorgan's digital dollar. Banks want crypto without the chaos. Now, while retail-focused NFT projects are bleeding, the biggest bank in the US is quietly doubling down on blockchain rails. JPMorgan is planning to issue its JPM coin directly on the Canton network, which is designed to let large institutions move money quickly while keeping sensitive data private. JPMorgan is essentially a tokenized representation of US dollar deposits at the bank, already used by institutional clients to settle payments within JPMorgan's own systems. By bringing JPM coin onto Canton, those tokenized dollars can move across a broader network shared by multiple financial institutions, instead of staying locked inside JPMorgan's internal ledger. The bank has also connected to Base, which taps into Ethereum, giving it a bridge into the wider on-chain ecosystem. This rollout is planned in phases through 2026, starting with the technical groundwork and potentially expanding later to things like blockchain deposit accounts. Zoom out and you see Morgan Stanley is seeking approval to launch crypto-linked ETFs, while Bank of America is preparing to let wealth advisors recommend crypto allocations with no minimum portfolio size. The same Wall Street giants that once called crypto a scam are now building regulated, bank-controlled versions of digital money designed to sit alongside traditional markets, not overthrow them. They don't want meme coins. They want programmable dollars, collateral, and settlement. Echoes of the dot-com bust, why this pain might be bullish. To really understand what's happening, look back at the late 1990s dot-com bubble. Investors were buying any company with .com in the name, often paying 100x to 200x earnings for businesses that barely had revenue. When it became obvious the profits couldn't justify those valuations, the bubble burst and hundreds of companies like Pets.com and Webvan vanished. Crypto has gone through a similar phase. At the start of 2025, as Donald Trump began his second term and promised to make the U.S. the crypto capital, Bitcoin, Ethereum, Solana, and altcoins ripped to new highs on pure FOMO. But as the year progressed, Bitcoin topped out around $126,000 in October, then dropped by almost a third within 2 months, dragging many altcoins down over 50%. The mood flipped from euphoria to fear, just like during the dot-com reversal. The crucial twist is that, like maturing tech companies, many crypto projects now have visible on-chain revenues from staking, fees, and DeFi activity, making it possible to perform crude price-to-earnings style analyses. In many cases, effectively paid 100x or more on earnings potential, echoing the dot-com excesses. That overvaluation is now being corrected, and the weakest, least useful tokens are likely to die off as a true bear market develops. But remember who survived the dot-com crash: Amazon, Google, and a handful of others that went on to define Web 2, social media, and cloud computing. The article's thesis is that crypto stands at a similar crossroads, where 2026 could be a year of brutal consolidation that wipes out hollow projects but lets the strongest protocols lay the foundations of a real Web3 era, where users have more control and value flows more directly. That's not just doom, it's creative destruction. What this means for you. So what does all this mean if you're watching BlockNexus TV trying to navigate this chaos? The NFT crash and Nike's exit signal that speculative narratives without revenue or real utility are getting repriced hard. Bitcoin's range and the focus on $80,000 support suggests more choppy consolidation before any decisive trend. So position sizing and patience matter more than predictions. JPMorgan and Wall Street's moves show that, while the retail casino is cooling off, institutional-grade digital money rails are quietly being built in the background. History says that from crashes come giants. The job now is to separate future Amazons of Web3 from the next Pets.com of crypto. If you found this breakdown valuable, hit like, subscribe to BlockNexus TV, and drop a comment. Is this the end of crypto hype, or the beginning of real adoption? Your take might be featured in the next episode.